Open a ZERODHA account. Chapter 6. Margin Calculator, Part 1. 6.1 The Margin Calculator. In continuation with our discussion on margins in the previous chapter, we will now discuss about the margin calculator. Over the next 2 chapters we will discuss about the margin calculator and also learn few associated topics related to margins. Do recollect, in the previous chapter we learned about the various types of margins required at the time of initiating a futures trade. Margins vary from one future contract to another as the margins depend on the volatility of the underlying. We will talk about volatility in the next module. But for now just remember that the volatility changes from one underlying to another. Hence the margins vary from one underlying to another. So how do we know what is the margin requirement of a particular contract? Well, if you are trading with Zerodha, chances are you would have come across the margin calculator. Zerodha's margin calculator is one of our popular offering. And rightly so. It is a simple-to-use tool that has a very sophisticated engine in the background. In this chapter, I will just introduce you to the margin calculator and help you understand the margin requirement for the contract you choose. We will revisit this topic on the margin calculator when we take the chapter on options in the next module. At that point we will understand the complete versatility of Zerodha's margin calculator. Let us take up a case where one decides to buy the futures contract of Idea Cellular Limited, expiring on the 29th of January 2015. Now in order to initiate this trade one needs to deposit the initial margin amount. We also know that the initial margin IM equals span margin plus exposure margin. In order to find out the IM requirement, all you need to do is this. Step 1. Visit https://zerodha.com/technology. Once you land here, click on Margins. I have highlighted the same in the image below. Step 2. You'll be taken to the margin calculator section. As you can see from the image below, there are many different options that are available. I have highlighted the same in black. However, our focus for now will be on the first 2 options called span and equity futures. In fact, by default you will land on the span margin calculator subpage, highlighted in red. Step 3. The span margin calculator has 2 main sections within it. Let us inspect the same. The red section has 3 drop-down menu options. The exchange drop-down option basically requires you to choose the exchange in which you wish to operate. Select NFO if you wish to trade futures on NSE. MCX if you wish to trade commodity futures on MCX. CDS if you wish to trade currency derivatives on NSE. The next drop-down on your right is the product. Choose futures if you wish to trade a futures contract, or if you wish to trade options. Select options. The third drop-down menu is the list of symbols where all the futures and option contracts are made available. From this drop-down menu, simply choose the contract you wish to trade. Since we are interested in Idea Cellular Limited expiring on the 29th of January, I have selected the same. Please see the image below. Step 4. Once you select the futures contract, the net quantity automatically gets pre-populated to 1 lot. If you wish to trade more than 1 lot, then you need to enter the new quantity manually. Notice in the image below, as soon as I select Idea Futures contract, the net quality has changed to the respective lot size, which is 2000. If I wish to trade say 3 lots, then I have to type in 6000, 2000 *3. Once this is done, simply click on the radio button, either a buy or sell, depending on what you wish to do, and finally click on the blue Add button. Once you instruct the span calculator to add the margins, it will do the same and it will give you the split up between the span, exposure, and the total initial margin. This is as shown below, highlighted in the red box. The span calculator is suggesting the following. Span margin equals 22,160 rupees per. Exposure margin equals 14,730 rupees per. Initial margin, span plus EXP, equals 36,890 rupees per. With this, You know how much money is required to initiate the futures trade on Idea Cellular. It is as simple as that. The next interesting section within the margin calculator is the equity futures. We will discuss the same in the next chapter. However, before we proceed to understand this, let us quickly understand three more topics, namely the expiry, spreads, and intraday order types. Once we understand these topics, we will be placed better to understand the equity futures on the margin calculator. 6.2 Expiry. In the earlier chapters, we briefly figured out what the expiry of a futures contract means. Expiry specifies the last date up to which the contract lasts, beyond which it will cease to exist. Consider this. If I buy Idea Cellular Limited futures contract at 149, expiring on the 29th of January 2015, with an expectation that it will hit 155, it simply means that this move to 155 has to pan out by the 29th of January 2015. Obviously, if the price of Idea is below 149 before the expiry, then I have to book a loss. Even if the price of Idea futures hits 155, or in fact any price above 149, on the 30th of January 2015, one day after the expiry, it is of no use to me as the contract has already expired. In simple words, when I buy a futures contract, it has to move in my favor on or before the expiry day. Else there is no point. Does it really have to be so rigid? Is there any flexibility in terms of going beyond the stated expiry date? Let me illustrate what I mean. I know that the central government budget is expected sometime around the last week of February 2015, which is a little more than a month away, considering today is the 19th of January 2015. I personally expect a good budget this time around. And I'm also hopeful that the manufacturing sector will significantly benefit from the budget in the backdrop of the Make in India campaign. Given this, I would like to bet that Bharat Forge, a manufacturing major, will significantly benefit from the upcoming budget. To be precise, I expect Bharat Forge to rally from now all the way till the pre-budget rally. Therefore, in order to exploit my directional point of view on Bharat Forge, I would like to buy its futures today. Have a look at the snapshot below. Bharat Forge January 2015 contract is trading at 1,022 rupees per. But here is a situation. My view is that Bharat Forge will rally from now all the way till the last week of February 2015. But if I buy the futures contract as shown above, then it expires on the 29th of January 2015, leaving me stranded halfway through. Clearly, since my directional view goes beyond the January expiry period, I need not be bound to buy the January expiry contract. In fact, for reasons similar to this, NSE allows you to select a contract that suits the expiry requirement. At any given point, NSE allows us to buy a futures contract with 3 different expiries. For example, we are in the month of January. Hence, we have 3 contracts of Bharat Forge with different expiry. The 29th of January 2015, this is called the near-month contract or the current month contract. The 26th of February 2015, this is called the mid-month contract. The 26th of March 2015, this is called the far-month contract. Have a look at the image below. As you can see, from the expiry drop-down menu, I can choose any contract between the current month, mid-month, or far month based on my specific requirement. Needless to say, I would choose the mid-month contract expiring on the 26th of February 2015 in this particular case as shown below. One thing that stands out clearly is the change in futures price. The contract expiring on the 26th of February 2015 is trading at 1,032 rupees per, while at the same time the contract expiring on the 29th of January is trading at 1,022 rupees and 80 paise per, which means the mid-month contract is more expensive compared to the current month contract. This is always the case. The larger the time to expiry, the higher is the price. In fact, as I write this, Bharat Forge Limited's March contract expiring on the 29th of March 2015 is trading at 1,037 rupees and 40 paise per. For now, just remember this: the current month futures price should be less than mid-month futures price, which should be less than far-month futures price. There is a mathematical reason for this. The same will be discussed when we take up the futures pricing formula. Also, here is another important concept you need to remember, as I had mentioned earlier. At any given point, the NSE ensures there are 3 future contracts, current, mid, and far month, available to trade. For now, we know Bharat Forge contract is expiring on the 29th of January 2015. This means the January contract can be traded till 3:30 p.m. on the 29th of January 2015. After which it will cease to exist. So does that mean from the 29th of January 2015 onwards, the January contract goes out of the system, leaving behind just the February and March contract? Not really. Till 3:30 p.m. on January 29th, 2015, the January contract is available. After which it will expire on 9:15 a.m. the 30th of January 2015. NSE will introduce April 2015 contract. So on the 30th of January we will have 3 contracts. The February contract would now graduate as the current month contract from being the mid-month contract until the previous day. The March contract would now be considered the mid-month contract, graduated from being far month the previous day to mid-month now. The April contract, which is newly introduced, becomes the far month contract. Likewise, when the February contract expires, NSE will introduce the May contract. Hence the market will have March, April, and May contracts to trade. So on and so forth. Anyway, continuing with Bharat Forge Limited futures contract example. Because I have a slightly long-term view, I can buy the futures contract expiring on the 26th of February 2015 and hold the February contract till I deem appropriate. However, there is another alternative as well. Instead of buying the February contract, I can go ahead and buy the January contract, hold on to it till around expiry, and very close to expiry, I can square off the January contract and buy the February contract. This is called a rollover. If you watch business news regularly, around the expiry time the TV anchors usually talk about the rollover data. Well, don't get too confused about this. In fact, it is quite straightforward. All they are trying to convey is a percent measure on how many traders have rolled over or carried over their existing positions from the current month to the mid-month. If there are many traders rolling over their existing long positions to the next month, then it is considered bullish. Likewise, if a lot of traders are rolling over their existing short positions to the next month, then it is considered bearish. This is as simple as that. Now, is this a proven technique to draw any concrete inference about the markets? Not really. It is just a perception of the market. So under what circumstances would one want to roll over rather than buy a long-dated futures contract? Well, one of the main reasons for this is the ease of buying and selling, aka the liquidity. In simple words, at any given point there are more number of traders who prefer to trade current month contract as compared to the mid or far month contract. Obviously, when there are more traders trading the same contract, the ease of buying and selling gets better. 6.3 Sneak peek into spreads. We are now at a very interesting stage. You may find some of the discussion below a bit confusing, but just read through this and try to grasp as much as you can. At the right time in future, we will talk more about this in detail. Just think about these 2 contracts. Bharat Forge Limited futures, expiring on the 29th of January 2015. Bharat Forge Limited futures, expiring on the 26th of February 2015. For all practical purposes, these are 2 different contracts, priced slightly differently. Both derives its value from the same underlying, i.e., Bharat Forge Limited. Hence they behave exactly the same. Meaning if Bharat Forge stock price in the spot market goes up, then both January futures and February futures price would go up. Likewise, if Bharat Forge stock price in the spot market goes down, then both January futures and February futures price would go down. At times, there are opportunities created whereby simultaneously buying the current month contract and selling the mid-month contract or vice versa, one can make money. Opportunities of this type are called calendar spreads. How to identify such opportunities and set up trades is a different topic altogether. We will discuss this soon. But at this moment, I want to draw your attention to the margins aspect. We know why margins are charged, mainly from the risk management perspective. Now, what kind of risk would exist if we are buying the contract on one hand and selling the same type of contract on the other? The risk is drastically reduced. Let me illustrate this with numbers. Scenario 1. Trader buys only Bharat Forge Limited's January futures. Bharat Forge spot price equals 1021 rupees per share. Bharat Forge January contract price equals 1023 rupees per share. Lot size equals 250. After buying, assume the spot price drops to 1011 rupees per 10-point fall. Approximate futures price equals 1013 rupees per. P&L equals 10 * 250 equals 2500 rupees per loss. Scenario 2. Trader buys January and sells February futures. Bharat Forge spot price equals 1021 rupees per share. Long on Bharat Forge January contract at 1023 rupees per share. Short on Bharat Forge February contract at 1033 rupees per share. Lot size equals 250. After setting up this trade, assume the spot price drops to 1011 10-point fall. Approximate price of January futures equals 1013 rupees per. Approximate price of February futures equals 1023 rupees per. P&L on January contract equals 10 * 250 equals 2500 rupees per loss. P&L on February contract equals 10 * 250 equals 2500 rupees per profit. Net P&L equals 2500 plus 2500 equals 0. Scenario 3. Trader sells January and buys February futures. Bharat Forge spot price equals 1021 rupees per share. Short on Bharat Forge January contract at 1023 rupees per share. Long on Bharat Forge February contract at 1033 rupees per share. Lot size equals 250. After setting up this trade, assume the spot price increases to 1031 10-point increase. Approximate price of January futures equals 1033 rupees per. Approximate price of February futures equals 1043 rupees per. P&L on January contract equals 10 * 250 equals 2500 rupees per loss. P&L on February contract equals 10 * 250 equals 2500 rupees per profit. Net P&L equals 2500 plus 2500 equals 0. Clearly, the point that I'm trying to make here is that when you are long on one contract and short on another contract, the risk is virtually reduced to 0. However, it is not completely risk-free. One has to account for the liquidity, volatility, and execution risk, etc. But by and large the risk reduces drastically. So when risk reduces drastically, the margins should also reduce drastically. In fact, this is what happens. Have a look at the following snapshots. This is the margin requirement 37,362 rupees per when we intend to buy January contracts of Bharat Forge. This is the margin requirement 37,629 rupees per when we intend to sell February contracts of Bharat Forge. And this is the margin requirement 7,213 rupees per when we intend to buy January contract and sell February contract simultaneously. As you can see, individually the January and February contracts require 37,362 rupees per and 37,629 rupees per respectively. Hence a total of 74,991 rupees per. However, when a futures contract is bought and sold simultaneously, the risk reduces drastically. Hence the margin requirement. As we can see from the image above, the combined position just requires a margin of 7,213 rupees per only. Another way to look at it would be from a total of 74,991 rupees per 67,658 rupees per, i.e. margin benefit highlighted in black is reduced and the benefit is passed on to the client. But do remember this, a simultaneous long and short position is built only when opportunities arise. These opportunities are called the calendar spread. If the calendar spread opportunity is not there, then there is no point initiating such trades. Key takeaways from this chapter. Zeroda's margin calculator is a simple tool that lets you calculate the margin required for a futures contract. The margin calculator has many versatile features inbuilt. The margin calculator gives the split up between the span and exposure margin. At any given point, NSE ensures there are 3 contracts of the same underlying which expire on 3 different but consecutive months. A trader can choose the contract of his choice based on the expiry data. The contract belonging to the present month is called current month contract. The next month contract is called mid-month. And the third one is called far month contract. On every expiry, the current month contract expires and a new far month contract is introduced. In the process, the mid-month contract would graduate to the current month contract. Calendar spread is trading technique which involves buying a certain month contract and selling another month contract simultaneously for the same underlying. When a calendar spread is initiated, the margins required are lower since the risk is drastically reduced. 70 responses to Taki cannot access the selected text from this type of page. It is a very special page. Open a ZERODHA account. Chapter 7. Margin Calculator, Part 2. 7.1 The Trade Information. I'm going to start this chapter by posting the same old question again. Why do you think margins are charged? Before you get annoyed and come chasing me, let me post the answer. Margins are charged from a risk management perspective. It helps in preventing any undesired counterparty default. The risk management system at the broker's office, often called the RMS system, is responsible for overseeing the overall risk management. You may be interested to know that the RMS is a computer program, and all orders placed by the clients reach the exchange only once this program approves it, which takes a fraction of a second. And there are people monitoring if everything done is right, wrong. When you place a trade, let us say to buy a futures contract via a buy order entry form, you are essentially conveying the following details to the risk management system, RMS. The contract you wish to buy, like TCS futures, Idea futures, etc. The quantity you wish to buy, number of lots. The price at which you want to buy, market or limit. Once you place the order, the RMS system evaluates the margin requirement and allows your trade to go through, provided you have the required margin amount. However, the information that you don't normally provide to the RMS system is the following. The duration up to which you wish to hold your trade. Is your trade intraday or you would wish to hold on to it over multiple days? The stop loss point, in case the trade goes against you. At what price point you would wish to book a loss and square off the position. Now, what would happen if you provided these additional details to the RMS system? Obviously, with the additional information flowing to the RMS system, it would develop a better clarity on your risk appetite. For example, the detail on the duration of the trade would let the system know how much volatility you are exposed to. If your trade is intraday, you are only exposed to one-day volatility. However, if your trade is for multiple days, then you are not only exposed to multiple days volatility, you are also exposed to the overnight risk. Overnight risk is risk of carrying the position overnight. For example, assume I'm holding a long BPCL, a major oil marketing company in India, futures position overnight. BPCL is highly sensitive to fluctuations in crude oil prices. Well, I'm holding the BPCL futures. Assume overnight the crude oil market shoots up by 5%. This will obviously have a negative impact on BPCL the next day as it becomes more expensive for BPCL to buy crude oil from the international markets. Hence, by virtue of holding BPCL position overnight, I will suffer a loss. Therefore, AM2M cut. This is called overnight risk. Anyway, the point that I'm trying to make here is straightforward. From the RMS system's perspective, the longer you wish to hold the trade, the higher is the risk you are exposed to. Likewise, think about the stop loss for the trade. By not expressing your intended stop loss, you are keeping the RMS system in total darkness with respect to your risk appetite. Denote: this is not mandatory information that you need to reveal. However, if you do, the RMS system gets more clarity on your trade. For example, assume I buy BPCL futures 649 rupees per. In the absence of specifying a stop loss, I'm virtually exposed to an unlimited risk. However, if I specify my stop loss as, let us say, 9 rupees per, then when BPCL falls to 640 rupees per, 649 to 9, I would book a loss and get out of the trade. Hence, there is complete clarity on the amount of risk I'm willing to take, which from the RMS system's perspective is a valuable information. So both the duration and the stop loss of the trade gives more clarity about your risk appetite to the RMS system. So what does this mean to you as a trader? Well, think about it. The more clarity you provide in terms of the risk you face, the higher clarity the RMS system develops. The more clarity it has, the lesser the margins required. Very loosely put, think about this as an equivalent to shopping for a television at a consumer electronics store. I know this may not be very apt, but I hope the following analogy gives you the right message. If you go to a consumer electronics store and inquire about the price of a television, the seller will assume you are a regular customer and he will quote the normal selling price. However, if you tell him that you are likely to purchase 50 televisions, he will instantly drop the price. In addition, if you tell him you are carrying the cash with you and are willing to finish the transaction right away, he will drop both his jaws and the price is even lower. The point is, as and when the shopkeeper gets more information about the transaction, the more attractive the price gets. 7.2 The product types. So far, one thing is clear. The more information, in terms of risk, you are willing to convey to the RMS system, the lesser is the margin required. Needless to say, the lesser the margins required, the more you can do with your capital. So, how does a trader convey this information to the RMS system? Well, there are specific product types that are meant for this purpose. While placing an order to either buy or sell, you can specify the product type. There are many product types and they vary from one another mainly in terms of their functionality and the information they convey to the RMS system. While the core functionality of these product types is standard, every broker calls them with different names. I will of course talk about the product types used at Zerodha. If you are still trading with another broker, I would request you to speak to them and identify the nomenclature used. NRML is a standard product type. Use this when you intend to buy and hold the futures trade. Remember, when you use NRML, the risk management system has no additional information on the length of your trade, as you can continue to hold the contract till expiry, nor does it have any information on the stop loss. You suffer losses, and therefore continue to pump in the required margins. Hence, because of the lack of clarity, the broker's RMS system charges you the full margins, i.e., span and exposure. Use NRML when you intend to buy and hold the futures position over multiple days, however do remember, you can use NRML product type for intraday as well. Margin intraday square off. Ms. Zerodha's Ms is a pure intraday product. meaning all trades placed as Ms. product type will indicate that the trade will last only for the day. You cannot select Ms. as an order type and expect the position to be carried forward to the next day. You have to mandatorily cut the position by 3:20 p.m., failing which the RMS system will do the same. Now because the product type is Ms., the RMS system clearly knows that it is an intraday trade, which is a notch better than an RML in terms of information flow. Remember, when the trade is intraday, the trader is exposed to only one day's volatility. Hence the margin requirement is lower compared to the NRML margins. Cover order, CO. The concept of cover order is simple to begin with, similar to Ms. The cover order, CO, is also an intraday product. However, the CO conveys additional information in terms of stop loss. This means, at the time of placing a CO, you will have to specify the stop loss as well. Hence CO conveys both the vital information, the length of the trade which is intraday, the stop loss, which is the maximum loss you will bear in case the trade moves against you. The snapshot below shows the buy CO form. The area highlighted in black is where one is required to specify the stop loss. Of course, I will not get into the logistics bit, explaining how to place a CO from the trading terminal, as we have already done that through an article in Z Connect. The point that I want you to be aware is this: by placing a CO, you are not only conveying that your trade is intraday, but also conveying the maximum loss you are willing to bear. Hence, by virtue of this, the margins should drop considerably, even lower than Ms. Bracket order, BO. The bracket order is quite versatile. Consider the BO as an improvisation over the cover order. Needless to say, a BO is an intraday order, which means all BO orders have to be squared off within the day on or before 3:20 p.m. While placing a BO, you will have to mention a few other things. The stop loss, at what place you would like to get out of the trade in case the trade moves against you. The trailing stop loss. This is an optional feature where you can trail your stop loss. We have not spoken about the trailing stop loss so far. We will discuss the same towards the end of this chapter. But for now, just remember the BO gives you an option to trail your stop loss. In fact, this is one of the most popular feature of a BO target if the trade moves in your favor. The BO also requires you to specify the price at which you would like to book the profits. The BO sends your order to the exchange where simultaneously you can specify the target and the stop loss. This is a huge relief to active traders as it helps them in many ways. Of course, for the logistics bit on how to place a BO, you can check out this article as it beautifully explains what needs to be done. The snapshot below shows the BO buy order form. The green box highlights the SL placements. If you think about the bracket order, the trader is conveying to the RMS system the same set of information as that of the CO. In addition, through the BO, the trader is also conveying the target price. Now, what difference does the information on the target price make to the RMS system? Well, it literally makes no difference to it from the risk management perspective. Remember, the RMS is only worried about your risk and not your reward. Hence, for this reason, the margin charged for BO and CO is the same. Let us now keep the above discussion in perspective and look into a few other options available on Zeroda's margin calculator. 7.3 Back to the margin calculator. Here is a quick recap. In the previous chapter, we introduced Zeroda's margin calculator. The objective of the margin calculator is straightforward. It helps the trader figure out how much margin is required for the contract he wishes to trade. In our quest to understand the same, we also understood concepts of expiry, rollover, and spread margins. With the help of this chapter, we are now clear about the information flow to the RMS system and its impact on the applicable margins. Let us keep these in perspective and look at the other two options highlighted in red provided in the margin calculator: equity futures and BO and CO. Here is a snapshot highlighting these features. Equity futures. The equity futures section in the margin calculator is a ready reckoner, as it helps the trader understand the following: the NRML margin required for a particular contract, the Ms margin required for a particular contract, the number of lots that a trader can buy for the given amount of money in his trading account. The equity futures section contains nearly 475 contracts as of January 2015. To understand this better, let us take up a few tasks. We will solve these tasks by using the equity futures section of the margin calculator. And hopefully in the process you will understand how to use the section better. Task 1. A trader has 80,000 rupees per in his trading account. He wants to buy ACC Cements Limited futures expiring the 26th of February 2015 and hold the same for 3 trading sessions. Find out the margin requirement for this contract. He also wants to trade Infosys January futures for intraday. What is the margin required? Does he have sufficient margins to initiate both the trades? Solution. Let us deal with the ACC futures first. Since the trader intends to hold the futures contract for 3 working days, we need to look for NRML margins. Denote. This task can be achieved by using the span calculator as well. We discussed this in the previous chapter. However, the equity futures calculator has a few more advantages over a span calculator. Visit the equity futures section and you can see all the contracts listed here. Scroll till you find the desired contract. I have highlighted the same in green. Do notice, the calculator is also listing the contract's expiry date, lot size, and the price at which the contract is trading. The black vertical box highlights the NRML margin for each contract. From the table, it is clear that the ACC February 2015 requires a margin of 48,686 rupees per. To find out the margin requirement for Infosys, I need to scroll down till I spot Infosys January contracts or simply type INFI in the search box provided. As we can see, INFI's NRML margin is 67,698 rupees per, highlighted in the black arrow, and MIS margin is 27,079 rupees per, highlighted in the red arrow. Do note the MIS margin amount is drastically lower compared to the NRML margin. Clearly, since the trade is for intraday, the trader can choose MIS product type and benefit from a lower margin requirement, which is 27,079 rupees per. Denote, the trader can select NRML product type even for intraday. There is no harm doing so. But when one does this, the NRML margin amount gets blocked. If one is clear in his mind about the trade being intraday, then it makes sense to opt for MIS and efficiently use the capital available. Anyway, the trader's total margin requirement would be 48,686 towards the ACC contract NRML margin as the trader wishes to hold the position for 3 days. 27,079 towards the Infosys contract MIS margins as it is a pure intraday product. Total margin of 75,765 rupees per, 48,686 plus 27,079. Clearly, since the trader has 80,000 rupees per in his account, he can initiate both the trades. Task 2. A trader has 120,000 rupees per in his trading account. How many lots of Wipro January futures can he buy on an intraday basis and on a multiple day basis? Solution. Search for Wipro in the search box provided. Next to the MIS margin column, there is an option to click on Calculate, highlighted in green arrow. Click on the same. After you click on it, a form sort of window opens up. You just need to enter the amount of cash in your trading account. By default, this is set to 100,000 rupees per. You can edit the same to meet your requirement. The price at which the contract is trading. In fact, this is pre-populated. Have a look at the screenshot below. The calculator suggests that I can trade up to 3 lots of Wipro futures under the NRML product type. Considering NRML margin is 36,806 rupees per lot. Also, under the MIS product type, I can trade up to 8 lots. Considering the margin requirement is just 14,722 rupees per lot. And with that, we know all the functionalities of the equity futures section of the margin calculator. As easy as that. We now move over to the BO and CO calculator. 7.4 BO and CO margin calculator. Both bracket order and cover order have similar margin requirements for reasons we discussed earlier. Using the BO and CO calculator is quite simple. In fact, it is quite similar to the span calculator. In the following snapshot, I'm trying to calculate the margin requirement for Biocon futures expiring on February 2015. Notice, I have selected everything that I need to, except for the stop loss. Without selecting the stop loss, I proceed and press the Calculate button. Notice when I do so, the calculator calculates the default stop loss that one can choose and the margin required. Now, once I mention the stop loss, the calculator calculates the amount as shown below. As per the BO and CO calculator, the stop loss one can choose is 403 rupees. Of course, you can vary the stop loss to any point, and the margins will change accordingly. Anyway, the margin required is 9,062 rupees per, which is remarkably lower compared to an RML margin of 26,135 rupees per and MIS margin of 11,545 rupees. 7.5 The trailing stop loss. Before we conclude this chapter, let us briefly discuss the trailing stop loss. The concept of trailing stop loss finds its application in bracket orders and in general plays a crucial role while trading. Hence, I guess it is important to know how to trail your stop loss. Consider this situation. In fact, most of us would have been in this situation. You buy a stock at 250 rupees, with an expectation that the stock price will hit 270 rupees sooner or later. You keep a stop loss at 240 rupees just in case the trade goes against you, and hope for the best. Things move as expected. The stock rallies all the way from 250 rupees to 265 rupees, just a few rupees away from your target of 270 rupees. However, thanks to market volatility, it starts to retrace back all the way to hit your stop loss at 240 rupees. So in essence, you saw profits coming in for a brief while, but were eventually forced to book a loss. How do you deal with such a situation? More often than not, we are always put in such a spot where we are right about the overall direction but get stopped out due to market volatility. Well, thanks to the technique of trailing your stop loss, you can prevent yourself from being in this situation. In fact, at times, trailing stop loss gives you a chance of making a better profit than you originally thought about. Trailing stop loss is a simple concept. All one needs to do is adjust the stop loss based on the movement in the stock. Let me illustrate this with an example. Here is a typical trade setup. Trade type long. Script Infosys. Instrument futures. Futures price 2,175 rupees per. Target 2,220 rupees per. Stop loss 2,150 rupees per. Risk 25 rupees 2175-2150. Reward 45 rupees 2220-2175. Clearly, the idea is to go long at 2,175 rupees and keep a stop loss at 2,150 rupees. The idea is to adjust the stop losses and when the price moves in the direction of the trade. To be precise, for every 15 points of price move in the direction of the trade, the SL can be adjusted accordingly. The SL can be adjusted to any level with an idea of locking in the profits. When you adjust the SL with an intention to lock the profits, it is called trailing stop loss. Denote. In this example, I have randomly opted for a 15-point move, but in reality it can be any kind of price move. Have a look at the following table. As in, when the price moves 15 points in the trade's favor, I trail my SL and thereby lock in certain amount of profit. Denote. The original price target was 2,220 rupees. But thanks to the trailing SL technique, I can ride the momentum and close in on a higher profit. Key takeaways from this chapter. The more information one conveys to the RMS system in terms of trade duration and stop loss, the lesser is the margin requirement. Use NRML product type when you want to initiate a trade and carry it overnight. NRML margins are the highest span plus exposure. MIS is a pure intraday trade. Hence the MIS margin is lesser than the NRML margin. In a MIS trade, only time information is conveyed intraday but not the information about the Stop loss. A cover order, CO, is also an intraday product. Besides in a CO, one has to specify the stop loss. A CO conveys both the time and the SL information. Hence margins are lesser than MIS. The margins for a bracket order, BO, is similar to a CO. In a BO product type, one has the option to specify both the SL and target price at one go. Besides, one can also trail the stop loss. A trailing SL technique requires one to adjust the SL as in when the script moves in favor of the trade. A trailing SL is a great way to ride the momentum in a script. There are no fixed rules for trailing. One can choose the trailing SL based on the market situation. 99 responses to Margin Calculator Part. Open a ZERODHA account. Chapter 8. All about shorting. 8.1 Shorting in a nutshell. We briefly discussed shorting in Module 1. However, in this chapter we will look at shorting in greater detail. Shorting is a tricky concept because we are not used to shorting in our day-to-day transaction. For example, imagine this transaction. You buy an apartment today for, let us say, Rs X. Sell it 2 years later for Rs X plus Y. The profit made on the transaction is the incremental value over and above Rs X, which happens to be Rs Y. This is a simple and a highly intuitive transaction. In fact, most of the day-to-day transactions requires us to buy something first and sell it later. Maybe for a profit or a loss. These are simple to understand transactions and we are used to it. However, in a short sale or a just shorting, we carry out the transactions in the exact opposite direction, i.e., to sell first and buy later. So what would compel a trader to sell something first and then buy it later? Well, it is quite simple. When we believe the price of an asset such as stock is likely to increase, we buy the stock first and sell it later. However, when we believe the price of the stock is going to decline, we usually sell it first and buy it later. Confused? Well, let me try giving you a rudimentary analogy just so that you can get the gist of the concept at this stage. Imagine your friend and you are watching a nail-biting India-Pakistan cricket match. Both of you are in a mood for a little wager. You bet that India is going to win the match. And your friend bets that India will lose the match. Quite naturally, this means you make money if India wins. Likewise, your friend would make money if India were to lose the match. Now for a minute, think of the India, as in the Indian cricket team in this context, as a stock. Trading in the stock market. When you do so, your bet is equivalent to saying that you would make money if the stock goes up, India wins the match. And your friend would make money if the stock goes down, India loses the match. In market parlance, you are long on India and your friend is short on India. Still confused? May not be, I suppose. But I would imagine a few unanswered questions crawling in your mind. If you are completely new to shorting, just remember this one point for now. When you feel the price of a stock is likely to decline, you can make money by shorting the stock. To short stock or futures, you will have to sell first and buy later. In fact, the best way to learn shorting is by actually shorting a stock futures and experiencing the P&L. However, in this chapter, I will try and explain all the things you need to know before you go ahead and short the stock futures. 8.2 Shorting stocks in the spot market. Before we understand how one can short a stock in the futures market, we need to understand how shorting works in the spot market. Think about the following hypothetical situation. A trader looks at the daily chart of HCL Technologies Limited and identifies the formation of a bearish Marubozu. Along with the bearish Marubozu, other checklist items, as discussed in the module, complies as well. Above average volumes. Presence of the resistance level. Indicators confirm. The risk and reward ratio is satisfactory. Based on the analysis, the trader is convinced that HCL Technologies will decline by at least 2.0% the following day. Now, given this outlook, the trader wants to profit by the expected price decline. Hence, he decides to short the stock. Let us understand this better by defining the trade. Stock HCL Technologies. Trade type short, sell first and buy later. Trade type short, sell first and buy later. Trade duration intraday. Short price 1,990 rupees per. Number of shares 50. Target price 1,950 rupees per. Percent profit expected 2.0%. Stop loss 2,000 rupees per. Risk 10 rupees per. Reward 40 rupees per. As we know, when one shorts a stock or stock futures, the expectation is that the stock price goes down and therefore one can profit out of the falling prices. So from the table above, the idea is to short the stock at 1,990 rupees. On the trading platform, when you are required to short, all you need to do is highlight the stock or futures contract you wish to short and press F2 on your trading platform. Doing so invokes the sell order form. Enter the quantity and other details before you hit submit. When you hit submit, the order hits the exchange, and assuming it gets filled, you would have created a short open position for yourself. Anyway, now think about this: when you enter a trading position, under what circumstances would you make a loss? Well, quite obviously you would lose money when the stock price goes against your expected direction. So, when you short a stock, what is the expected directional move? The expectation is that the stock price would decline. So the directional view is downwards. So when would you start making a loss? When the stock moves against the expected direction. And what would that be? This means you will start making a loss if the stock price, instead of going down, starts to move up. For this reason, whenever you short, the stop loss price is always higher than the price at which you have shorted the stock. Therefore, from the table above you can see that the short trade entry is 1,990 rupees per and the stop loss is 2,000 rupees per, which is 10 rupees per higher than the entry price. Now, after initiating the short trade at 1,990 rupees per, let us now hypothetically imagine two scenarios. Scenario 1: the stock price hits the target of 1,950 rupees per. In this case, the stock has moved as per the expectation. The stock has fallen from 1,990 rupees per to 1,950 rupees per. Since the target has been achieved, the trader is expected to close the position. As we know, in a short position, the trader is required to first sell at 1,990 rupees per and later buy at 1,950 rupees per. In the whole process, the trader would have made a profit equal to the differential between the selling and buying price, i.e., 40 rupees per 1990 to 1950. If you look at it from another angle, i.e., the usual buy first and sell later angle, this is as good as buying at 1,950 rupees and selling at 1,990 rupees. It is just that the trader has reversed the transaction order by selling first and buying later. Scenario 2: the stock price increases to 2,000 rupees per. In this case, the stock has gone higher than the short price of 1,990 rupees per. Recollect, when you short, for you to profit, the stock needs to decline in price. If the stock price goes up instead, then there would be a loss. In this case, the stock has gone up. Hence, there would be a loss. The trader shorted at 1,990 rupees per. After shorting, the stock went up as opposed to the trader's expectation. The stock hits 2,000 rupees per and triggers the stop loss. To prevent further losses, the trader will have to close the position by buying the stock back. In the whole process, the trader would have suffered a loss of 10 rupees per 2,000 to 1990. If you look at it from the regular buy first sell later angle, this transaction is as good as buying at 2,000 rupees per and selling at 1,990 rupees per. And again, if we reverse the order, it would be sell first and buy later. Hopefully the above two scenarios should have convinced you about the fact that when you short, you make money when the price goes down and you lose when the price increases. 8.3 Shorting in spot, the stock exchange's perspective. Shorting in the spot market has one restriction: it strictly has to be done on an intraday basis. Meaning you can initiate the short trade anytime during the day, but you will have to buy back the shares square off by end of the day before the market closes. You cannot carry forward the short position for multiple days. To understand why shorting in the spot market is strictly an intraday affair, we need to understand how the exchange treats the short position. When you short in the spot market, you obviously sell first. The moment you sell a stock, the back-end process would alert the exchange that you have sold a particular stock. The exchange does not differentiate between a regular selling of stock from demot account and a short sale. From their perspective, they are of the opinion that you have sold the shares, which would obligate you to deliver the same. In order to do so, you need to keep the shares ready in your demot account by next day. However, the exchange would know about your obligation only after the market closes and not during the market hours. Keep the above discussion in the back of your mind. Now, for a moment, let us assume you have shorted a stock and hope to benefit from the price decline. After you short, the price has not declined as expected and hence you decide to wait for another day. However, at the end of the day, exchange would figure out that you have sold shares during the day. Hence, you would be required to keep these shares ready for delivery. However, you do not have these shares for meeting your delivery obligation. This means you will default against your obligation. Hence, there would be a hefty penalty for this default. This situation is also referred to as short delivery. Under a short delivery situation, the exchange would take up the issue and settle it in the auction market. I would encourage you to read this article on Z Connect, which beautifully explains the auction market procedures and how penalty is imposed on the client defaulting on delivery obligation. A piece of advice here: never get into the short delivery situation. Always make sure you close your short trade before the market close. Else the penalty could be as high as 20% above your short price. Also, this leads us to an important thought: the exchange anyway checks for the obligations after the market closes. Hence, before the exchange can run the obligation check if one were to cover the short position by squaring off, then there would be no obligation at all by end of the day. Hence, for this reason, shorting in spot market has to be done strictly as an intraday trade without actually carrying forward the delivery obligation. So does that mean all short positions have to be closed within the day? Not really. A short position created in the futures market can be carried forward overnight. 8.4 Shorting in the futures market. Shorting a stock in the futures segment has no restrictions like shorting the stock in the spot market. In fact, this is one of the main reasons why trading in futures is so popular. Remember, the futures is a derivative instrument that just mimics the movement of its respective underlying. So if the underlying value is going down, so would the futures. This means if you are bearish about a stock, then you can initiate a short position on its futures and hold on to the position overnight, similar to depositing a margin while initiating a long position. The short position also would require a margin deposit. The margins are similar for both the long and short positions and they do not really change. To help you understand the mark-to-market M2M perspective when you short futures, let us take up the following example. Imagine you have shorted HCL Technologies Limited at 1,990 rupees per. The lot size is 125. The table below shows the stock price movement over the next few days and the respective M2M. Day ref price for M2M, closing price P&L for the day. 01. Initiate short 1990-1982-125 extension 8 equals 1000. 02. 1982-1975-125 extension 7 plus 875. 03. 1975-1980-125 extension 5 equals 625. 04. 1980-1989-125 extension 9 equals 1125. 05. 1989-1970-125 extension 19 equals 2375. 06. Square off 1970-1965-125 extension 5 equals 625. The two lines marked in red highlights the fact that they are loss-making days. To get the overall profitability of the trade, we could just add up all the M2M values. Plus 1000 plus 875, 625, 1125 plus 2375 plus 625 equals 3125 rupees per. Alternatively, we could look at it as Selling price, buying price asterisk lot size equals 1990 to 1965 asterisk 125 equals 25 asterisk 125 equals 3,125 rupees per. So, shorting futures is very similar to initiating a long futures position, except that when you short you profit only if the price declines. Besides this, the margin requirement and the M2M calculation remains the same. Shorting is a very integral part of active trading. I would suggest you get as comfortable with initiating a short trade as you would with a long trade. Key takeaways from this chapter. Shorting requires us to sell first and buy later. Short trade is profitable only when the closing price is lower than the entry price. When the price goes higher than the price at which one has shorted, then there would be a loss. The stop loss in a short trade is always higher than the price at which one has shorted. One can only short on an intraday basis in the spot market. The short positions cannot be carried overnight in the spot market. The short position in the futures market can be carried forward overnight. The margins requirement for both short and long trades are similar. The M2M computation is also similar for both short and long trades. 210 responses to All About